let's next consider how to make time paths for the variables we're interested in our money market analysis of the nominal money market. Now, time paths turn out to be very useful tools. We do our analysis, we move things around in our diagram. As we know, this moves interest rates around, money supply around, price level around. And then if we trace out how those variables move over time, that's what data looks like. So now we've used our analysis to generate fake data, but if we look at a newspaper or we look at actual data, we'll see those patterns and be able to figure out what must have happened in our diagram. So the first step to knowing how to do time paths is I'm just going to make a note. Technically, when we look at time paths, we like to use logs of variables like natural log of the money supply and the natural log of the price level, because it means the slopes equal percentage change. So if I'm plotting the log of the price level and I do this, and the slope here is 10% and the slope here is 0, I can literally read that as 0% inflation and 10% inflation. Now, in general, we'll kind of just forget about it and call it the time path of the price level, but technically we're doing the log of the price level so that the slopes turn into percentage changes, and we can think of it as inflation and so on and so forth. So you'll see where that shows up here. You don't need to worry about it. You can just leave it in the back of your mind. But let's do our two examples. Example 1 was a boom in the economy that increased the real GDP, which we know will increase the money demand, which we know from our earlier analysis will increase the interest rate. If you put that into our diagrams, we had this. Here's where we started. Money demand increased. And this pushed up the interest rate. All of this is the same thing. Now we want to draw 3 time paths: money, prices, and the interest rate. So if we look at that here, we'll have the log money supply. Notice it never changed here. We're technically tracing out this path. So it goes along here. It never changes. The log of the price level. Since money never changed, the price level never changed. And it looks like that. The one that did change was the interest rate. And for the interest rate, we can see it was here and it's jumped up. So we started here, and then at some time money demand increased and the interest rate just jumped up. Quite a boring drawing, quite boring analysis, but technically we've now done time paths. The interesting time paths are in example 2 when we see an increase in the money supply. An increase in the money supply, as we recall, will have a different short run and a long run effect. So if we take the money supply here, money demand, and we start here in the short run, we know higher money supply will just push out the money supply. End of story. No problem. That pushes down interest rates. This is the short run effect. The long run effect, let me do that in blue, is that the money supply translates into higher price level, which translates into higher nominal money demand. That increases money demand to there, pushing interest rates back up to their original position. So we went from here to here to here. This pushed interest rates back up. Now those are handy notes, but it turns out that the time paths really make a very clear and interesting story. So now we have money supply. At some time, the money supply increased. Notice the slope didn't change. It was a one-time increase, but let's say a 10% increase. What happens, and it's always the same order, you'll notice I go money, price level, and then interest rates. When this shock hit, prices adjust slowly. So they don't move initially, but they eventually rise all the way up until the change in prices is the same as that change in the money supply. The effect is that this jumped out, and this is where the time path is valuable. Here's the I naught and I1. At the time this shock hit, the interest rates drop immediately, but as prices catch up and this moves upwards slowly, as prices adjust slowly, interest rates return to their old level. Because prices adjusted slowly, the money demand moved out slowly, and the interest rate adjusted back to its old level slowly. How quickly this adjustment happens is totally lost in these notes, but captured in the time paths, which is why we do them.